we will proceed from where we had left off last week. Okay. You have asked, I hope this is not your very first online class that you are attending in Zoom. So you have two ways of communicating to me. Number one, from my end, I'll talk slow because I know internet connectivity issues, voice cracking, all this can happen. So I'll be talking a little slow in terms of the speed so that it's not affecting your understanding too much. And from your end, I hope you know there are two ways you can communicate. Either you can use a chat box or right typo, or you can unmute and speak. You can unmute and speak. Both are equally acceptable for me, but communicate. It shouldn't be like I am sitting in front of the laptop and for the next. And yeah, obviously, I know online section 4 hours or 4.5 hours, it's pretty long. Don't worry, I'll give you ample enough break. A lengthy breakfast break will be given. Apart from that, I'll be giving one more break so that you get enough time to refresh yourself. Okay, to get a break, definitely yes. Now we will resume from where we left off last day. That is, I hope you remember, we were discussing about questions under marginal analysis. We couldn't complete the questions. We couldn't complete all of those. So that's where we are going to restart things. When I share the questions with you, if the question is repetitive, that is, if we already have practiced this question in the class, because I'm handling multiple sections sometimes. So because we had started, but we didn't complete. So when you see the question, if you feel we already have practiced this question in the class, let me know. We can skip and move on to the next one. We just need to, we don't have to repeat and waste our time. We just have to do fresh questions. So I'm going to share the screen. We're going to practice the questions. And if you feel the question was already done in the class, we had practiced in the last section, let me know. Okay, that is, I should be able to pick it, but sometimes I may miss it out. Good, Sounder. I'm happy to see that you have replied back. Similar replies, I hope I'll see from rest of you as well. You can use the chat box. You can very well use the, what do you say, the smileys and the gifs and all as to reply as well. To reply as well. Everything is fine. I just want to confirm that uh, it's audibility and you are able to attend the class in a smooth manner. So once again, remember, I will talk in a little slow pace. The reason being, I understand that if I go like a bullet train in an online section, it can affect your understanding. So before I share the screen, so I can see six of you here. Sounder, Sandosh, Sneha, Nisarga, Durai, and Navanida, which means three of you are missing. Three in the sense, I can't say, okay, where is Durai? Okay, I can see all three boys in here. Then Sneha is there, Ida is there, Nasaka is there. So I think three girls are missing out here. I hope we have informed in the class group. Okay, one more student has joined. Seven of you. So we have um, two more students to join. Um, I don't know who amongst you is the CR, the class representative. I think if I'm not wrong, Sridaksa usually asks Nusarga to take an attendance. Nusarga, so after a while, not now, let's give them a bit more time. Just see who are the absentees and drop a list to Sridaksa. Is that clear? Yeah. Okay. So once again, remember, thanks Nusarga for the quick response. Once again, do remember, um, you can either use the chat box or you can unmute and speak to communicate in the class. I'm going to share the screen, and at this time, I believe it's going to be interesting because many of you will be at different places. So let's see how well you guys are answering. Unlike the class where you guys were discussing an answer, right? Discussing an answer. So this is the first question that we're going to look at. Marginal analysis, not a new topic that we already had covered, topic where we had practiced. That's where we are going to start with, or rather resume with. Help me with the answers, please. First question of the day. Read the question, decide on what to do. Can see 8 of you have joined, so one person is missing. Let it be. Now, answers, please. A, B, C, D. You can either use the chat box or you can unmute and speak. Either way, with what is the answer that you're getting? What's the answer you're getting? Two answers. Okay, two answers. Both the answers say C. Thanks, Sonder and Zarga. Thank you. I will wait. Two more answers. C, C. Okay. Unanimous answer thus far is C. Again, C. Okay. I got 5 responses, all 5, now 6. All 6 responses unanimously. No, some those, let me see the answer. Okay. This answer is also C. So unanimously, all the answers are C. So let's verify this. Let's confirm this. Reynolds Incorporated manufactures several different products, including a premium lawn fertilizer and weed killer that is popular in hot, dry climates. Reynolds is currently operating at less than full capacity because of market saturation. They sell a 40-pound bag. So it's like, say, for example, 50 kilogram rice bag you see. Similarly, 40-pound bag is what they are selling, fertilizer. Selling price is given, the costs are given. It is, as of now, it's a loss-making item. 1.5 of loss is there. On the basis of this, what action will you recommend? We know that when you decide on whether to shut down, whether to discontinue an item or not, like a loss-making item that you're looking at, we'll not focus on the accounting profit, like what they have given, rather we'll focus on the relevant one. And applying that logic, what will basically happen? Sorry. What basically should happen here? Give me a second. Just doing the math in here for convenience, that's all. We'll find out the contribution of the item. We'll consider only the relevant cost and the relevant revenue. So selling price of 18.5 12.5 minus only the relevant goods. So 12.25, it's material and labor that will reduce 12.25. Variable overhead, it is variable again, so that also we will consider 3.75. Then the last item given, fixed cost, allocate fixed overhead. That's fixed overhead. So unless in other ways they say somewhere that it's specific to the product, we do not have to consider that. We don't have to consider that. So we'll not take it, we'll ignore it. So what's remaining? 2.5, but it's a positive figure. It is a positive figure. So they have a loss of 1.5, but when you disregard, when you don't look at that for a fixed cost, basically it's a beneficial product at a benefit of 2.5. So the point being, we should not drop it. We should not be dropping it at all. That's basically what we should do. Select a different cost driver to allocate. It's not about cost allocation. Drop this product. Definitely we should not drop. Continue the product. That's option. That's what we should do. And market this product. Why there's a market? Because it has already reached market saturation. So maybe through marketing, you can increase the demand level in the market. That's the hope that we are having. Increase output and spread the fixed overhead over a larger. We'll not do it immediately. We'll do it after the market has improved. After there is more demand in the market. Until then, we'll not. So the immediate thing that we can do, keep continuing to produce it and try to increase the demand by increasing the marketing, make people aware about our products so that more people start thinking about buying our product. Then once the demand increases later, you may go for increasing the production level. That's for later. So the answer now, C. Good. Very happy to see all of you pick the correct answer. The next question. I think this question we practice in the class. Am I right? I remember seeing it in the recent past. Did we practice this in the class already?
Yes.
90, 25, 18, and 4, I think 137. I think I've seen
Answer
this
is
in the
option C,
class.
sir.
Option C, yeah. So we have done this. We have done this, yeah. I remember seeing it in very recent process. This also we have done. I hope you remember a lengthy question that we have done. Urban store and suburban store. This we have practiced already. This also we practiced. The tricky one, I hope you remember. The very tricky one where we had to adjust, and the answer, I think, if my memory serves me right, was 6.75. This we practiced. Okay, I think this one we have not wrong. Doesn't ring a bell to me, but correct me if I'm wrong. This question. C. Okay, thank you, both of you. Two answers, identical answers from both of you. Thanks, Nisarga and Sonder. Second, I'll wait to see others' response as well. Okay, today says C, another C. So two C's and two B's. Two C's and two B's. Let's see. Let's wait. B, C, B. Okay. Popular answer is B, but there were a few C's as well. There were definitely a few C's as well that I could see. Okay, let's go. Let's go. Let's discuss. So now what happens with this one? Sorry, excuse me. So in this question, we'll use this calculator only. Not sure whether it is visible to you, so I'll just confirm that. Yeah, it's visible. So I'll keep this calculator here for your reference. What's basically happening? The cost of the product will come to, okay, it's very, very minutely visible. So I'll close it. I'll just switch it. In this question, the variable cost or the specific cost add up to 49.5 plus 49.5 plus 16.5 plus 9.5. 16.5 plus 9.5. This is the normal variable cost. But additionally, we also need to consider, because they say this is coming from an international customer. The question is very precise. This one is coming from an international customer, they say here. And the additional shipping cost for the international delivery. So it's specific. It is specific to this order that you have received from this international customer, right? It's additional cost, how much? 4 per unit. So that also we need to take here. We don't need to take the fixed cost, but this is additional specific cost. We have to consider that. So total will add up to 79.5. This is a cost. What is offer price? At what price they are ready to buy it? Normally we sell it at 95, but for this order, the customer is ready to pay only 80. So we have to decide whether we have to offer it or do it at 80. So 80 minus 79.5. Actually, it will be profitable, but very marginally, very little, $0.5. $0.5 into how many units are there in that order? $0.5 into 1,500 units. This order is for 1,500 units. So I'll not be bothered about this 95 because that's a normal price from the regular customers. This special order, the customer is offering you to buy it at 80. And we have to consider the specific cost of that. So fixed cost, again, non-relevant. 49.5, 16.5, 9.5, that will take. Additionally, we have to take this whole. And this, again, it's just given to miscommunicate or rather to mislead us. Doesn't matter. That's irrelevant, that fixed overhead. So 0.5 into 1,500 units, 750. Remember, it's profit, small profit of $0.5 per unit. So total, it will actually increase the profit. The answer should add up to 750. The answer must add up to 750. Thank you. Good for all of you who said B. And again, for even people who have not given B, rather chose C. I don't know what mistake you have done, but thank you for the working. I hope you got the logic. Let me just see what you may have done. 6,750 divided by 1,500, 4.5. So you did not consider that 4. You mixed out that 4. That's what has happened. Remember that 4 is specific to this order. It's coming from the special order is from an international customer. For that international orders, we have to pay an additional shipping cost, incremental. additional shipping costs. So it's incremental, it's specific to the project or rather to the order. So we need to factor it in. We need to consider that. I hope the answer is clear to one and all. Yeah, by the way, for any question, once I have confirmed the answer, any question, not just this, any question to come as well. Once I have confirmed the answer, if you still have a doubt, please do feel free to ask. If you still have a doubt, please do feel free to ask me. Okay, I hope that's clear. Ask and clarify. Ask me to repeat. I'll happily do that for you. So that's that, which takes us to the next one. Okay. I believe it's an easy question. Let's see. Let's see what I'm getting from all of you. So about course behavior. Thanks, Vivek, for the quick response there. I'll wait to see what others say. Give me more answers. A, C, A, C, C. Okay. Popular answer is C. There are a few A's as well. Okay. Let's discuss. See, this is a very easy question. The way I look at it, it's an easy question. Okay. Why? All they are asking is what is the total cost for 7 units? They have given the average fixed cost and the average variable cost. All I have to do 36.86. This is a total average cost for 7 units, right? For 7 units. So all we have to do is 36.86. 36.86 multiplied by 7 units. Multiplied by 7 units because that's the average cost of 7 units total. The 258.02. The question was what is the total cost? The answer that way will come to 258.08. Total cost for 7 units. If they had asked me, okay, what is the total fixed cost? I'm just giving you an example. At any unit, you'll take what? Say 6 into 50. At 6 units, what is the total cost? I'll do what? 6 units into 50. Logically, this should not change at different levels of activity. So yeah, look at the last one. 9 units into 10. 9 to 10 will come to that 100. Sorry, 90. Will come back to that 90. That way it will take. So yeah, obviously they can give you a question like this and they can ask you what is the total fixed cost or what is the total cost. Anything for that matter. Okay, the answer is there C. Answer is C. Again, if you have a doubt, feel free to ask away. I can go back and explain one more time. The next question. The next question. Okay. This question Okay. I don't think we have practiced this in the class. Correct me if I'm wrong. I don't think we have practiced it. It's same background as what we had seen earlier, but slightly different question. Slightly different question. So read through it and attempt it. Read through it and attempt it. Can you see that I already have got answers? Let's see what answer I have got. Thanks, Duray, for the good response. I'll wait. Let's see what others say. Okay, Sounder, thanks, dear. Two answers, identical answers thus far. Same answers until now. Same answers until now. Wait. We'll wait. Same answer from Noeda. Same answer from Sneha. Okay. It's a 7 times 7. Well, all the answers thus far have told me it's B. All the answers thus far has told me that the answer is B here. They're asking under the circumstances, the minimum amount that Collins would charge. Minimum amount. So it's minimum will be what they don't. Minimum means they're looking for profit and all. They want to cover the cost. That's all. The relevant cost will consider. This is a company which is working already at full capacity. So in order to produce a special order, they'll have to stop the regular product. They're working at full capacity. So in order to do the work, the special order, they have to stop the regular work. They have made it crystal clear to you, which means we'll have to consider the variable cost or rather the relevant cost. The relevant cost will add up to 90 plus 25 plus 18 plus 4. Only the variable items. 90 plus 25 plus 18 plus this 4 that we have to consider. So when you add it, 90 plus 25 plus 18 plus 4. 25 plus 18 plus 4. That's a variable cost. But can we stop it there? No. We need to also consider the contribution loss, what we call as opportunity cost. The loss contribution. How much? We lose 15,000. This other product provides 15,000 basically of contribution during that time. So 15,000 is what we get from the regular work by then that we are going to lose. What is the order size of this new order? 500. We lose 15,000 on the regular work if you do this. And this time they have not given per hour and all wherein we have to convert like in the earlier question. So we can directly take the entire 15,000. But it is for how many units? 500 units. We basically have to recover it back. By selling this 500 units, we have to recover back this 15,000. So 500, we'll use that to divide it. 15,000 divided by 500 per unit. We are losing 30 per unit. We are losing 30. So that 30 also we need to add 137 plus 30, 167. Like almost all of you have given the answer. All of you have given it as B. I'm happy to see that. Good work. Neat work. The next question. The next question. This we had practiced. I hope you guys do remember a lengthy theory question. We had discussed the reasoning also in the class. The next question. Okay. Next question. Okay, nice question. Let's see what it is say. Four answers. I'm sorry, I lost track of time. Four answers. Let's see what are the answers I have got. C. Thanks, Amber. Dure says B. Thanks, dear. Three more answers I have got. C. Anusha says C. Sneha says A. Navnina says B. So it's scattered all around the place. All around the place. But I think two or three answers I got a C. Another B. Okay. Now, I like this question because it's pretty good, if you ask me. A company plans to add a new product that would affect its indirect labor cost in two ways. First, the production manager from an existing product would serve as manager. So that production manager is already part of the company. Okay, that person manager is already part of the company. So now you will shift that person. Instead of him being the production manager, you will ask that manager to manage this new product, number one. Then, so what will happen, that new product, sorry, the old product, he is, as of now, he or she is the production manager. So you are shifting that person from the production manager to this product, new product. So what will happen to the old product? Her as current assistant manager, so it's a she. So that production manager's current assistant manager will be promoted. So for the old product, the manager of the old product will manage this new product. He'll be shifted, or she will be shifted to this work. And who will manage the old product now? Because now that job comes in. Why? Because you have shifted this person. So that product will be now handled by this person, this production manager's assistant manager. And she'll be basically promoted from the assistant manager. She'll be promoted to production manager from her previous position. Second, the existing maintenance staff would provide facility and machine maintenance that would require 30 hours of labor work. But they made it clear no increase in their total weekly hours worked. So basically, we are not actually paying anything extra. In other terms, we are not actually asking them to do anything extra. It's part of their normal work. Within that, they'll include this also. That's what they're saying, which means for the maintenance part, we don't need to consider anything extra. For the maintenance part, we don't need to, 13 to 20, we don't need to take it because they made it clear there's no extra increase that is happening because of the contract. Nothing is happening. But what will happen? The production manager, earlier we mentioned about it, the production manager. So because of the new product, what basically will happen? Because of the new product? Because of the new product? Old product. Two things will basically happen. The old product manager will get transferred as the manager here, will be transferred here. But that person is not having a shift in the job profile and role. It's the same. Number one. This is number one. Okay, it happens because of the new product. This shift is happening with the new product. But for this, we are not paying anything additional. For this, we are not paying anything extra because that manager is already a manager. She is being asked to handle a new product, that's all, from the old product. But what also will now happen, now this old product, who will manage it? The current assistant manager, the assistant manager will be promoted. The current assistant manager will be promoted here to manage the old product now. Remember, if this new product did not come, this promotion will not happen. Right? Think about the incremental. If this new product did not come, the old manager would have continued with the old product. This promotion would not happen. So this extra promotion happens because of we are not hiring anybody extra either. They have made it clear. Right? Because the question categorically says that no extra hiring is being done. They're just reshuffling the existing workers and getting it done. They're not hiring extra people. They're just reshuffling the workers and getting the work done. So the manager basically transferring and doing different work, nothing extra we have to pay because the same rank. But the assistant manager is getting promoted to manager here. What is the pay for assistant manager? For manager, the pay for the manager as per the scenario is 60,000. What is the pay for the assistant manager? 50,000. Look at the scenario. They say it's 50,000. The scenario says, where are we? Yeah, production manager 60,000 annually, whereas assistant managers 50. So that assistant manager is getting promoted to a product manager of all product. Yes, but this decision all happens because we decided to deal with this new product. If not, everything would have continued this way. So this increase in salary, how much? 60,000 minus 50. I don't know how to take the entire 60 because 50,000 was already anyways paid to the assistant manager. Now the assistant manager will be paid extra 10,000 because he's getting promoted. He or she is getting promoted. How much? 10,000. This is relevant. The incremental extra portion. This is relevant. This is relevant. Not the entire 60,000 because the assistant manager has already paid a salary 50. Without the new product, the assistant manager is paid 50. And the current manager will be paid 60. That is not changing. But the additional portion is that assistant manager gets promoted to a production manager because of the product, earning him extra 10,000. And like I said, maintenance though, the repairs and maintenance, so they are not doing anything extra. The total hours remains intact. So without this work, that payment would have happened. Without this new product, that would have happened. So the only relevant portion here is this extra 10,000, incremental, additional 10,000. Answer will be C. The answer will be C. Can I have a confirmation from everybody? Is the logic? Where again, very good work. Quite a few of you did pick the answer as C, not all of you. One or two, I think, had picked the answer as C. Very good work. I think Sounder and I don't remember who else. Sounder and one more student, if I'm not wrong, had picked it as C. Let's see. Anusha, I think it was Anusha. Again, very good work to all who picked it as C. Okay, happy to see that. Yeah, one more time. Let's go. What happens? Two changes happens. The new product basically will bring two changes. Number one, what will happen? It's a reshuffling between the team members. There is old product for which we have a manager and a assistant manager. Assistant manager. When the new product comes in, what will happen? For the new product, the same manager will get reshuffled. That's all. The same manager is going to get reshuffled in here. So, the same manager is going to be shifted to this job here. Is going to be shifted. So, this manager is now paid 60,000. This manager is now paid 60,000. The same salary will continue. The same salary will continue in here as well. Nothing extra in here. That manager is already being paid 60,000. But now what will happen? Because the manager is now handling the new product, old product, who will handle it? The assistant manager will be promoted. The assistant manager will be promoted. Assistant manager, now the salary is 50. Assistant manager salary currently for the old product is 50. But now what will happen? Now to deal with the old product, you are going to promote. We are going to promote this manager. We're going to promote this manager, this assistant manager as a manager. We are going to promote this manager, which means that person's salary will increase. That person's salary will increase from 50 to 60. So old manager will just shift the product, will handle the new product. So whether it is old product or new product, she'll be paid 60, nothing extra. Nothing extra. But the assistant manager who was already part of the company for the old product, now that person will be asked to deal with the old product. So what will happen? 50,000 because he or she is now a manager. Instead of 50, we have to pay 60. So because of the decision to do the new product, how much extra on a net basis the company is incurring? They're not paying anything extra to the new product manager, but to the assistant manager who gets promoted, will end up paying 60 minus 50, 10,000 extra. This is a direct result of the new product. This is a net result of the new product. The old manager will continue, but in the new product, that's all. That's same 60,000 only. But the assistant manager will be now promoted to handle the old product. The assistant manager will be now promoted to handle the new product. Old salary for that person was 50. Now it will become 60. So additional 10,000. Because of the decision to do the new product, the company will incur additional 10,000. Nisarga, this much are we good? This much is the logic, the reasoning there clear? Yeah. Now the remaining part, the last part, which is the repairs and maintenance stuff. And that's actually straightforward. The question clearly tells us that they're not going to do anything extra. They're not going to do anything extra in their department. They tell us that this job requires 30 hours of labor work. Yes, but actually we are not asking them to do anything extra. There's no overtime and all that we'll actually ask them to do. So it basically is a case where if not this, some other work they would have done, we would have paid for it. We would have paid for it. So there is again nothing incremental for them. There's nothing additional for them that is coming from them. So the only relevant question here is the additional cost, the future incremental cash flow. Because of the decision to do the new product, the extra cost the company will incur is only the 10,000. And that's the answer. Are we good? Can I have a final confirmation before we move on? Ziga, are we cool? Okay. Thank you. Thanks a lot for asking and confirming that. And thanks, Neha, for the response as well. That's that. Let's go the next one. Okay. That was first. Thanks, Dure, once again. Two answers, identical answers. I'll wait. Another answer, identical answer. C, C. Let's go. Let's close it off. Let's discuss and close it up. I hope you will pay attention. This is a theory question. There's no calculations to be done. We should be able to do it faster. Let's see what the answer should be. All the answers is C, and I happily concur, happily agree. The answer must be C. A company's approach with a make or buy decision. When you make a make or buy decision, as we know, we'll consider two costs. We'll compare two costs. What are the overall actually? What are the extra cost of buying? The extra cost of buying will be compared with the cost that we can avoid internally, which we call as avoidable cost, variable cost, and any specific cost that we can avoid internally that also will consider. So that's the answer. A company, when they make a decision on whether to make or buy, they'll consider number one, the buy cost. Number two, all the costs they can avoid internally. They'll compare the buy cost with the savings, this buy avoidable cost. Yes, the answer is C. This one we had practiced in the class. I hope you guys do remember. We had practiced this question in the class already last Saturday. This also we have practiced in the class. I hope you guys do remember. You had given me the answer correctly for this. This also we had practiced in the class, the last round. Okay. Next question, again, I believe easily doable question. Okay. Unanimous answers this one. Those were all the answers that I will read. Okay. Okay. Profits that are lost by moving an input. Input is basically what? A resource. Material, machinery, workers, their labor effort, all of these are inputs of a business. They are all resource of a business. So basically, we can say profits that are lost by moving one resource from one use to another. So what we are losing, the earnings, the profit or the contribution that we are losing when we shift from one job to another is what we refer to as what opportunity cost. Like we keep saying, the value of next best opportunity for one. When you stop the regular work to do an extra work, we are losing the contribution of the regular work. We'll call it as contribution loss. We'll call it as opportunity cost. This is something that we have kept discussing so many times. So they are just using a different terminology, different wording to communicate. But the idea is the same. Rather than using the textbook definition, they are wording it in a slightly different manner. That's all. Idea is the same. Opportunity cost. C. Sorry, D. Good. Almost all the answers that I received was D. Very good. Next question. This we had practiced in the class. This we had practiced in the class. We had discussed that. Okay. Uh, yeah, this we had practiced this. I think 10 was the answer. 50,000 divided by 5%. Yeah. Last question. Give me a minute. KT. Okay, this also we had discussed in the class, right? Think I remember seeing this. It was slightly tricky, but yes, sir. Yes, sir. Just quickly confirm. Okay. Group capacity. Yeah. We have to shift the hours. We have to shift the hours while a question. Correct. We had practice, I think 96.5. Yeah. Done. So yeah, that set is over. I'm happy. Yeah, good. We have finished it within the planned time. I thought it will go until 9:15. Within the planned time, we have finished it. I'm happy to see that. Now, we'll go for a break. Obviously, we're going to go for a break. When we resume, it's going to be a breakfast break, a decent break. I'll give you half an hour break. I know you're at the comfort of your homes, but still I'm giving you that much time so that you have your breakfast, have some chill, have some fresh air, stretch yourself, get some, maybe if you like music and all, listen to it, and then be back fresh by around 9:35. Don't leave, okay? Don't leave. I just need one help. I want to shift my laptop because online, when I use this, the system that I'm using, it's a little slow. So I'll just, for time being, Sounder, I hope you'll not go out. I'm going to make you the host. I'm going to keep you the host. Okay. And I'm going to go out of the meeting. I will go out of the meeting. I'll join back. Okay. Please don't leave. Quickly open my other system and I'll log in and then you can leave. Just one piece of information that I like to tell you. If you get logged out, when I'm trying to transit, if I'm getting logged out, don't have to worry, you can log in back at the time of around, you can log in back around 9:40. Will be received by around 9:40. I just want sounder only to stay back for another 2 minutes, others may leave. You can log back by 9:40. Okay, that is, of course, you can stay logged in also. It's absolutely up to you. It's absolutely up to you. Second. Okay, fine. Great. I have logged in back with my system. Thanks, Sounder, for staying back. I have taken back the host rights. You guys may leave. You guys may leave. 9:10 is the time now. You can have a 30 minutes break. Please be back by 9:40. Okay, please be back by 9:40. Thank you. Welcome back. Okay. Guys, give me a minute. Something has happened to my Zoom account. Okay. Works now. Okay. So the next unit, so to speak, that we're going to begin with, give me a minute. I'm downloading the files for it because it was there in the old system. I have to get it from a J drive. Sorry, excuse me. Okay, the next unit that we're going to begin with. We finished CP analysis, cost volume profit analysis. We had covered marginal analysis also now, and the different situations that we deal with using marginal analysis, make or buy, shutdown of sell or further process, disinvestment. So many such scenarios we have looked at already. Right. The next area that we're going to start with is pricing. And with respect to pricing, it's kind of intervened a lot with what we call as the excuse me, sorry, what we call as the uh, economics. Sorry, what we learn under economics. It kind of is intervened with a lot of things that we learn in economics. Okay, there are multiple things that we have to cover with respect to it. Again, a bit of theory, actually a lot of theory, and numbers. Both are there. Both are basically there, which we will cover one by one, slowly and steadily. We are going to cover it. Okay. Uh, what I want you people to um, understand here, once again, since it's an online section, if the moment you feel that I'm talking way too fast, the moment that you feel that I'm talking way too fast, is that it impairs your understanding, it affects your understanding, please do chip in, please do warn me so that I can slow it down for you. Okay, I can slow it down for you. I hope you guys will cooperate with respect to that. Okay, hope complete cooperation with respect to that aspect. Now, give me a second. Sharing the screen with all of you. Sharing the screen. Hmm. Done. I hope now the PPT is visible to all of you. I can see 9 of you being present. Good to see all 9 being here. Good. Okay, pricing distance. That's the final area we're going to cover. The next 2.5, 3 days. What basically happens with this area? We have, like I said, numbers and theory. There's a long list of topics to cover. We'll talk about how to set price, market-based pricing, cost-based pricing, target pricing, how the supply and demand in a market, as you may have learned in your economics, the graph and how it can affect the prices that we'll discuss. Price elasticity demand, a very popular concept, PED, price elasticity demand. Again, something that you may have learned in your, not may, mostly in our commerce studies, in our economics, commerce or economics, may have learned about it. That we'll have a relook in this particular part. Then similarly, regulation of price, government intervention, and there is a bit more other topics also in between that we have to cover, that we have to cover as part of this module. So I'm not going in the perfect order here. We're not going in the perfect order here because it's a first online class. I really don't want to like push a limit in an online section. So we'll start with a few random smaller topics which are easy to relate to and which has more numbers, which has a bit more numbers as well. And then the next 2 days we'll spread the theory.
Of course, I cannot completely, on any day when it comes to this area, I cannot completely skip theory. We have to cover a bit of theory every day. First of all, what do we mean by this pricing decisions? Obviously, we are here trying to, if you remember, in marginal analysis, we had made many decisions, or we were trying to make decisions on whether to do a particular project or not, whether to make or whether to sell, sorry, whether to buy, whether to continue selling an item or discontinue, whether to replace a product with another product or another service. Many such decisions we made. And in many of those cases, the price the customer was ready to pay or the selling prices and all was given to us in the question. But this chapter, this unit or this chapter, this is about how to fix the price. Which price? Selling price, the revenue per unit. Right? How to fix the price, the different factors, the different considerations that must be looked at, the different factors that must be considered, right? That must be looked at when we fix the price, when you're setting up the price of a product or a service that you're wanting to sell. Whether it is a product or a service that you're wanting to sell, what all factors must be looked at when you fix that price. That's what this chapter or this unit is all about, pricing decisions. And when we say that, I hope it will very easily should come to you. Since you guys have been commerce students already, what do you think? What all different factors? Remember, they will not ask you an essay question in the exam wherein you have to by heart a long list of different factors and then go and repeat the same thing in the exam. That will not usually happen in our exam. But, and yeah, obviously, depending on the textbooks that you refer to, whether you're referring to a CBSE textbook, whether you're referring to an ACCA or a CMA or a CPA textbook, the different factors that can affect the price. When a textbook describes the different factors that can affect the price, the individual factors from textbook to textbook, the wordings and all may differ case to case. But there'll be a lot of common features, common factors. And whatever you see in a textbook is not an SOC list. They're not association, it's not a complete list. There could be other factors as well always. There could be other factors as well always that may have to be considered when you look at the list. So we don't have to by heart the list as such. But especially in an MCQ situation, when a list of items is given, you have to be able to apply your logic and decide what all had to be factored, how to be looked at. So now, the two popular aspects that we are going to cover with respect to price. And within that, the area that we are going to focus now will be on the cost factor. Why? What is pricing? Setting up the price. Pricing decisions is all about setting up the selling price, right? It is about setting the selling price per product or per service. That's what this unit is all about. So usually the thumb rule, as we all know, will be that we will try to understand the cost of a product or a service. We'll try to understand the cost of a particular product so that the selling price can be set at a level higher than that. That's logically usually what we'll do. Right? We'll usually try to set the selling price at a level higher than the cost. We'll calculate the cost, usually calculate the cost, then add the profit that we want, add the profit that the company wants. Automatically, what will happen? You'll get the selling price. This will result in selling price. Say a product is costing you $100. You want a profit of 40. So 100 plus 40, 140 will be the selling price. This is a usual flow. And that's what we'll basically look at when we say cost-based pricing. And that's the area that we'll focus on. And therein, we'll look at two methods today. Target cost-based and life cycle costing. These two we'll cover. At that time, we'll also start discussing about market-based factors. And then tomorrow, we'll continue with this market-based factors. We'll start talking about the supply and demand. We'll talk about price elasticity of demand and the regulation of prices. All the other factors, we'll start seeing it tomorrow. That's how we'll take it. But before we go there, you guys tell me, when, say, for example, you are running a business. You are running a business. So you are basically the manager or the owner of a business. When you're fixing the selling price of your product or your service, when you're fixing the selling price of your product or your service, of of the product that you want to sell or the service you want to sell, what all factors you will consider? You can unmute and speak, or you may use a chat box. Both are fine with me, as always. But let me repeat my question. What all factors do you think, or what all factors you will consider when you are setting up the selling price of your product or your service? What all factors will you consider? Can anyone tell me? What all factors? One obviously is cost, like you guys would, I hope you would agree, because we want to always set the price at a level higher than the cost. We want to recover the cost. Only then we'll get profit. No, we have to fix the price always higher than the cost. Sorry, I'll just give me a minute. Okay, I'll just take my phone. Just give me a minute. Okay, I have got a few responses. Let me see what I have been told. Profit, agreed, Nisaga. The company may have a profit in their mind. They may have a desired profit, right? Most cases that we are going to deal with as a CMA, we are looking at profit-seeking entities. So they don't do things for charity. They're not doing it for social well-being and all. They want a profit. So yeah, profit could be a factor. Sandosh says market condition. Yes, happily agree. Yes, market situation, market competition level can affect the pricing, which again is a part of our discussions. It's going to be a part of our discussion as well. Demand, agreed. Very much agreed, Dure. Yes, I happily concur. Arun, cost of production, demand, yes, cost, yes, agreed. All of these are valid factors. All of this that you guys have told me, risk. Okay, to a extent, yes. Market risk in a way. Why? Because if you set the price too high, sometimes your product may not be appealing to the customers and all. Many such things will be there. I'm happy that I'm getting responses. Like I said, what all you guys out said, they are all correct only, but they are not the only factors. They are not the only factors. There could be many other factors also. So let's look at a list. Let's look at a list that I have compiled. Remember, you don't have to buy hard because it's not a school exam or college exam where you have to go to the exam and exactly repeat it. By heart the points and then go and repeat it. No. We just need to be aware about what all factors can affect. So what all can affect? Number one, the demand. Like you guys, some of you have idea. Demand and price, and demand and supply in that manner, you would say, can affect cost. We can say demand and supply, cost of a product, always yes, because usually we want to sell the product at a level higher than the cost. So that, like Nisaka said earlier, we need a profit, right? We don't do things for charity. So we'll get that profit if the selling price is always set at a level higher than the cost. Then market competitors. Some people say it's market situation. Some people call it as the competition. Both are the same in a way, right? The situation in the market, very, very valid. Market competition, the market situation can affect the pricing. Monopoly, oligopoly, you may have learned about it in economics, which is part of our discussions as well. We'll see. Pure competition market, monopolistic, how all this can affect the pricing. That will be market factors which we'll consider, which we'll discuss as we go along. Price sensitivity. In other terms, we'll talk about PED. Again, another factor that we'll discuss in detail. When you say demand here, we need to also add supply. Substitute products. This for your product. Now, can anybody tell me an example of a substitute product or substitute products? Can anybody tell me examples of a few substitute products? Anyone? I assume that you guys have learned business studies and economics in your 11th or 12th or even college. So you may have heard about substitute products. Can you give me an example of substitute products? Coca-Cola and Pepsi. Thanks, Rakshita. I happily do agree. Coke and Pepsi are substitute products, soft drinks, substitutes. Tea and coffee, to an extent, of course, people, there could be preferences, but tea and coffee are substitute products. If you want to travel interstate, so you want to travel from Karnataka to Kerala or Tamil Nadu, etc., flight and train, or even buses for that matter, are substitutes that way. They're services, but they are Samsung and Apple, they're competitors. I'll not say they are. Yeah, in a way, yes. To an extent, yes. So I hope you got the idea. I hope you got the idea of what is substitute product. Substitute products means what? We can use one item as a substitute for the other item. So these things can affect the pricing. So for example, you are basically a tea. You cultivate tea. You have a tea plantation. So what will usually happen if something happens to the substitute product, say coffee beans? If it becomes very limited in availability, the supply of coffee product, that is coffee beans in the market, becomes very little in the market. Automatically, what will happen? So supply is cut off, maybe because of some production issues and all. Supply of the other product, coffee, is getting cut off in the market. So obviously, coffee's price will go up. It will also result in an increase in our product. It can lead to an increase in our product. There will be more people who now run tea because coffee is not available or it becomes unaffordable. The price goes high. So that way it can affect each other. Substitute products can affect each other. It can affect each other's demand and obviously as a price. Suppliers. Who are suppliers and creditors who will give us the raw materials, the components. They can affect the price big time. Say a car making company, a Toyota or Hyundai, a company. As we know, they don't produce everything of a car by themselves. Tire could be coming from MRF or Seat, like that, different tire companies. The the mirrors could be coming from other company. Battery, if it's an EV, battery could be produced by another company. Or some business, like so for example, BYD has their own production units for battery, but otherwise, most of the companies, what will they do? They basically purchase this battery and all from outside. Like the different components. They'll purchase it, they'll bring it together. Or a laptop. Think about a laptop, Samsung, Asus, Dell, etc. What do they do? Motherboard, battery, camera, all these kind of things. Some of it they have their own in-house production, but many components they'll purchase from outside. And this components they'll bring it together. They'll club it together, assemble it together. So suppliers, if they increase their product price, right, whatever they are providing us, if they increase the price of their product, what will automatically happen? If they increase the price of their product, it will lead to increase in the cost of our product. Because suppliers provide us with raw material. Just give me 1 minute. Okay. So, yeah. So suppliers, they provide us with the raw materials and all. They do provide us with the raw materials, the components, the direct materials. So, and the other components. So if they increase their price, it means it will increase our cost base. This will increase our cost base. Automatically, we'll be pressured. Higher the cost of the product, we will be under pressure to increase our price as well. We'll be under pressure to increase our price. Inflation level in the market. Market situation. It's under the market situation, but it's not about competition, but the economic situation. Are there inflation? If there is inflation, it means raw material in general will be having higher price. It's not suppliers doing it. And the market situation is such that prices are high. Automatically, if inflation is there, it can lead to higher selling prices because cost will increase, quality. And this is a lot about perception as well. How the customers perceive, how the customers look at our products. Why? If the product is looked at as if it's a high quality product, if the market perception is that, the market view, the customers believe that our products are of high quality, it automatically gives us a leverage. Leverage in the sense it will automatically give us a bit of freedom to set a higher selling price. to set a higher selling price. I hope you would agree. Higher the quality, usually, again, not a rule, but usually the such sellers, such companies will be able to set a higher selling price. Income level of people in an economy can affect the prices. Some of you might remember in your economics, you may have heard the concept of disposable income. You may have heard about the disposable income in a household. What is disposable income? The income remaining with a family or with a person, a household, after meeting their regular expenses, after meeting their monthly regular expenses. That's disposable income. So if we are primarily operating in a market, in an area or in a market, a geographical location, where everybody is very rich, like say, for example, Luxembourg. I'm giving an example. Or a Scandinavian country or a Luxembourg kind of a country where the average income is very, very high. The average income is very, very high. People are very, very rich. Almost everybody is very rich. Then the way you will set the price will be very different. You'll charge very premium rate for many products because you know that they can afford it. Whereas if you're selling in a very price sensitive market, wherein the average income of people is very less, the disposable income is very less, when you know that they are finding it difficult to meet their rents. There could be few rich people, but majority of them are not having that ultra rich life. Then what will happen? The pricing will be that way. For example, I don't know how many of you do use Netflix, but I hope all of you do know about Netflix, right? All of you don't know Netflix. In India, they have a mobile pack. I think 199, that is 200 rupees per month. In India, they have a pack like that. Again, no disrespect to our country, but in India, we have a pack like that. A very affordable kind of pack compared to their international pricing, compared to how they price things internationally. Netflix do it. Now, compare that with, let's say, a country like Luxembourg or Sweden, etc. Do they have that kind of a affordable entry-level packing? No, they don't have that kind of a pack, that kind of an offer. Why? There they perceive that the average income of people, even the youngsters, is higher. So they believe that people will be ready to pay a higher rate to buy their subscription. But Indian market is huge. There is huge size. And if it's set at a normal level, what will the Indians do? We may go for other kind of options like Telegram or other kind of options. So they'll lose money. So what will they do? They'll give a very affordable pack. So they can cash in on students and many other bulk people. So that way incomes can affect the pricing. So when Netflix, it's an international company, how they price their plans in India, the packing or rather the combo packs they offer in India or in our country will differ depending on the income level. Similarly, ethics. You will later talk about market competition. At that time, we'll talk about monopoly. If you're a monopoly player, a single player in the market, automatically you might have all the freedom. So ethics and all will play a huge role there. Even other ways, by the way. So for example, I'm coming from Kerala. Kerala is a consumer state. We don't manufacture that many items. So we purchase raw materials or rather vegetables, fruits, etc. We get it from Karnataka or Tamil Nadu, etc. Mainly. Sometimes what will happen, the local suppliers, they'll cut the supply. The local distributors, say onion, for example, or tomato, they'll cut the supply for 1 or 2 days. So when they cut the supply into the market, the Kerala market, what will happen? Supply is less, the price level will go high. When the supply, there is good demand, there is regular demand, but then the supply is cut off. What will happen? The price will increase. The supply into the market is cut off, the price level will increase. So price is high, but item is not available. That situation. What we call as black marketing. Sometimes you may have heard the term black marketing. So they are wantedly cutting up the supply. Not because the item is in scarcity, not because it's not available, but some suppliers, they'll do the foul play. All they do, they will wantedly cut off the supply so that it is not easy to get the item. Automatically, what will happen? The price will increase. The way the price will increase. The price will increase. Then they will sell it at a higher rate. When the price in the market increases, then they will clear off all their stock at a very high rate. Such ethics can play a role. Again, remember, this is not a complete list. There could be other factors, like say, for example, government regulation. A quick point that immediately comes to my mind, government regulation. There are certain industries where it's regulated by the government, so you cannot fix the price higher than that, like airlines in India, for example. So there are many such things. Are we good? Are we clear with these factors? Can I have a confirmation, please? Are we good? Are we clear thus far? We just looked at some of the many different factors that can affect the price or price of a product in the market. They can affect the price of a product in the market. That's what we looked at up until now. Okay. Okay. So far, so good. I hope it's all clean and neat until now. So now we are going to switch over. We're going to slowly talk about the different factors. Within that, we'll start off with what? The cost part. We know one of the many factors that can affect the pricing is cost. As we all know, we should always try to set the price at a level higher than the cost. Selling price should be usually set at a level higher than the price so that we enjoy the profit. What is profit? The difference between selling price and the cost. So we'll always try to do that. So when we do this, okay, there are other things, price and supply and demand, how we can affect the price, and this graph and all we'll discuss. Okay, in the coming days, we'll discuss. But I'm just, like I said, since it's the first day of online section, I just don't want to bombard you with a lot of theory. That's all. We'll come there. We'll see that later. So cost-based pricing. We'll start with the basic way of doing it, cost-based pricing. What will usually happen? Typically what will happen, companies will identify the cost of their product. They'll calculate the cost of their product. And then to that cost, they will add the price. Add the profit, you'll get the selling price. To the cost, we'll add the profit the company wants, we'll get the price. But when you say this cost and the pricing exercise, be very careful with the wording. Phrasing, wording. We already have discussed this in the class many times. We already have discussed that. They will play with the words. It's your responsibility, right? It's your responsibility to make sure that you properly understand what they are meaning. You properly understand what they mean and work it out, right? Work it out accordingly. So cost-based pricing. So usually what will happen, we'll set the selling price at a level higher than the cost. That's a basic idea. Right, the agenda here is very simple. When you use the cost as a base, always set the price at a level higher than the higher than the cost, my bad. Set the selling price at a level higher than the cost. This, in question, sometimes they will phrase it, they will word it in two ways. And it has two different meanings. Maybe in your max studies, you may have learned. So you might already know. Some of you may know, some of you may not know. So I want to have a quick recap, a discussion. It's not a CMA kind of a topic. It's more of a max topic, but wordings, very, very important. Why? Because depending on whether they use word number 1 or word number 2, when they describe how the profit is set and they describe how to calculate the price, depending on whether it is number 1 markup or number 2, whether it is margin, the calculations will differ. Depending on whether it is markup or margin, the calculations do differ. So we have to be very precise. We have to be very accurate. We need to know what it is. What is the basic difference between markup and margin? We must be very, very aware. We must be very, very aware, and we must consider that in our calculation. We must include that in our calculation. Let's go. Yeah, before I go, let me just ask and confirm to all of you, all 9 of you. Do you guys know the difference between markup and margin? I'm sure in your max studies long back in your school and all, you may have learned about it, but you may have forgotten. Some of you may still remember, some of you may have forgotten. Do you know the difference between markup and margin? Give me a yes or no. Even if you have an ounce of doubt, give me a no. No, sir. Thanks, Santosh, for the straightforwardness. No. Okay, good. Enough. Thanks, Zaga. Thanks for the straightforwardness again to all 3 of you. Good. I'm happy. So let's first start with this. Let's first understand what is the fundamental difference between markup and margin. Why? Like I told you earlier, how we calculate either the profit or the selling price, how we calculate the profit or the selling price will differ. It does differ, it does change depending on whether it is a markup or margin. So we cannot rush and take it casually because they'll give you in MCQ questions, they'll give you both options. They'll give you both options. Okay. Give me a second, guys. I'm sorry. Hmm. Okay. So how does it work? For that, I'm going to share the screen. Done. Let's look at these two cases. First, I'll explain using this small example. What basically the difference between mathematically the difference between markup and margin. What is the fundamental difference when it comes to markup and margin? Now, it's very simple. In cases of markup, I hope Excel screen is now visible. Let me just confirm. Is the Excel screen visible? No. Okay. So I'll stop sharing the screen. I'll reshare this time with the Excel screen as well. Excel and PPT. Okay. Okay. Please wait. The screen should be visible to you. Yeah. Now, I believe the Excel screen is visible to you as well. So in case of markup, what will the base? The base will be the cost. The base here will be the cost. So the base, when I say the base will be 100%. Base will be usually the 100%. And that base will be cost. Let me put it here. Base will be the cost. So in case of markup, the base will be the cost. Now, to give you as an example, let's say the cost of a particular product is calculated to be 200. The cost of a particular product is calculated to be $200. And the company wants a profit of, let's say, 20%. The company wants a profit of how much? 20%. 20%. So what will happen? How will you calculate the selling price? How will you fix the selling price? Here, what will the base? Base will be cost. The foundation will be the cost. So this $200 is my 100%. My base is the 100%. This 200 is my 100%. Which means the selling price here will be 120% technically. Means 100% the cost plus 20% of that additional. 100 plus 20. There are two ways of calculating it. The selling price now. 200 is a cost. So 200 into 1.2 times or 200 into 120%. 200 is my 100%. So what should be 120%? Or calculate 1.2 times. 1.2 times, as you know, is 120%. 240. Or there is another way of doing it. What is it? Separately calculate 20% of cost. So 200 into 20%. 200 into 20%, how much it will come to? $40. So 200 plus 40, 240. This is how we normally do it as well. This is how we normally do it. I hope all of you do agree. And that's the case with markup. Then what about margin? What happens with margin? Let me just enlarge it one more out. How does it differ when it comes to margin? When it comes to margin, the base, that is again 100%, the base will be the selling price. The base will be the selling price. That's the biggest difference. The base will be the selling price, not the cost. So the 100% will be the selling price. Now let me work backwards just to show you an example. Okay, let me work backwards just to show you an example. So we have the same 240 selling price. Question says the selling price is the same 240 and the company is looking for a profit margin. But this time not markup, the question says margin. The key difference is in the earlier case, left case, It was markup. It is, in this case, it is margin. The second case, it's margin, 20% margin. So the cost here will be a small percentage within the selling price. What is the base here? The base, the foundation will be selling price, 100% will be selling price. And profit will be a small percentage within that, which means 100, logically 100 minus 20, 80% should be the cost. 80% what of the selling price. So coming in here, $240 into 80%. 240 is 100%. It is the base, the selling price. Into 80% will be the cost, or should be the cost. 192 will be the cost. The profit will be not, it won't be not 20% of the selling, sorry, the cost, rather, even the profit will also be a percentage of what? 20% of the selling price. What is the selling price? 240. So 48. 192 plus 48 will add up to 240. 190 will be the cost, the selling price, the profit will be 48, and the selling price will come to 240. Now look at it. Just see this. Same selling prices, but depending on whether it is markup or margin. Same selling prices, same percentage. But in one question, one scenario, it's been described as markup. Whereas if the next question says it's margin, the values do differ. Selling price is the same, but the cost value and the profit values are different. Similarly, let's say, for example, again, case of margin. One more time, case of margin. This time, let's start with the same cost. Let's start with the same cost that we had seen earlier. That is, cost, let's assume it is 200. And we are looking for a markup of, we are looking for a margin of, this time margin of 20%. What will happen? This 200 literally should be 80%. This 200 should be 80%. So what it means is 100% should be what? 100% should be the selling price. 200 is 80, 200 must be 80%. So the selling price should be 100%, the base. Why 80%? Because 20% markup is, margin is assumed, 20% margin. So what will you do? The math involved will be 200 is a cost that is available. I want to find the 100%. 80% is available, given 20% profit looking for. So what is 100%? How will you do the math? 200 multiplied by, either divide by 80% or multiply by 100 upon 80. 200 is 80%. What is 100? How will you do it? How will you spike it up? 200 into 100 upon 80, 250. This time look at it. Selling price, same 200, 200. But in the case of market, when you are looking for a profit of 20% markup, profit will add up to 40, answer will be 240. Selling price is 240. But in case of margin, the same cost being 200. But if the question says they want a margin of 20%, the question says they want a margin of 20%, then what basically will happen? 200 into 100 upon 80, because 20% should be the profit. So 80% should be the cost, 250 will be the selling price. And of course, the margin profit will be 250. The selling price is the base because it's margin 250 into 20%. 50 will be the margin portion. So simply speaking, I can summarize and say, wrap up and say, in case of markup, the base, the reference is cost. The 100% the base is cost. And the profit is an extra percentage added to the cost. So automatically the selling price will be at a higher level. Here 20%, so 120. If next question they say 25%, the selling price would have been 125%. So in case of markup, the base, that's the most important aspect. The base, understanding the base. In the case of markup, the base is the cost. The base is the cost. But in the case of margin, the base is the selling price, 100% selling price. So in case of markup question, we apply the percentage usually on the cost. In case of margin, 100% is considered as a selling price, and we apply the calculations accordingly. And of course, in markup, we add to that 100% of cost to find the selling price. In case of margin, 100% is a selling price. So the cost and the profit will be a smaller percentage within that. What is a profit percentage? So 30% profit they're looking for. So 100 minus 30, 70% must be the cost. So there's difference in wording. We have to be very aware, because as you can see, same cost, 200, 200, 200 and 200. But depending on whether it is a case of margin of 20%, markup of 20%, then the profit is, selling price is 240. Whereas when it's a margin of 20%, then the selling price is 250. Profits differ, selling prices differ. So we have to be very cautious. You can't take it casually. Why? Because both these options will be given. If they give a question like this, they'll give you 240 and 250 as the options to confuse you. Are we good? Are we clear with the fundamental difference between markup and margin? Is this clear to everybody? Is a mathematical difference between markup and margin clear to everybody? Please do confirm. Are we clear? Are we good? Thank you. Others? Okay. One more time. In case of markup, cost is the base. Cost is 100%. Yeah, sure. We're going to see a question, Saka. We're going to see a question. Okay, we're going to see a full-fledged question as well. In case of markup, 100% is the cost. But in the case of margin, 100% is the selling price. Everything is applied as a percentage of margin. Sorry, percentage of selling price. The base is 100% here. That's the fundamental difference. Now coming in, now since you asked about margin, before I go to the next question, to everybody, let's just see a case. Consider margin. Consider it's a case of margin. Let's say cost of a product is, let's say, 150. Cost is 150. And they are looking for a profit margin. Okay. They're looking for a profit margin of 40%. What will the selling price? Cost per unit, cost per product or cost per unit is $150, and they're looking for a profit margin. They are looking for a profit margin of 40%. If that is the case, what do you think will be the selling price? What is the selling price here? Can anyone tell me? Can anyone calculate and tell me? Thanks, Santosh. I'll wait. Let's see what others say. It's a case of margin. Santosh says 210. I'll wait. Let's see what others say. Santosh says the selling price will be 210. Others. If it's a case of margin, what will be the selling price here? And it says 250. Okay. So this is 210. Okay. I hope everybody understood the question. It's a case of margin. Cost is given as 150. They want a profit of 40%. They want a profit of margin of 40%. What must be the selling price then? 250, 210, 250. Okay. Guys, all of you who said 60, sorry, all of you said selling price is 210. See, you are again applying markup. No, you're applying the markup there. When you do 150 into 40%, 60, and when you add it, what are you doing? You're doing markup there. I repeatedly kept saying it's margin. We are looking for margin here. In case of margin, cost is not my 100%. We'll not apply the percentage on the cost. What is 100% in case of margin? 100% in case of margin is selling price. 100% in case of margin is selling price. Not this. What you did is, sorry, case of markup. What you did exactly is markup. That's wrong. Then what is the point of me explaining all of it until now? If the cost per unit is 150, if it is 150, and if they are saying profit markup, they want a profit markup of 40%. When they say they want a profit markup of 40%, there we'll say what cost is 100%. Cost is 100% portion. Right? Cost is the 100% part. Profit is 40%. So the selling price, we'll say selling price is 150 into 1.4 times, or 150 into 140%. This 100 plus 40. 210, or 150 into 40% will add. See, the percentage of 40 or 30, etc. on the profit, of profit, will calculate that as a percentage of the cost in which one? In markup. In markup. So 210 is wrong. 210 is wrong. I can repeatedly say it, margin. In case of margin, what is my base? My base is selling price. 100% is selling price. And if they are looking for a profit margin of 40%, what should be the percentage of cost here? Let's first understand that. Understanding the percentage is very important when it comes to margin. So if they're looking for a margin of 40%, what should be the percentage of cost here? What should be the percentage of cost here? 60. Thanks on the 375. The idea. Be with me. Don't go anywhere. No, it will not go to 365 rule. What is the percentage of cost here? 60. And I happily agree, 60. Why? Base is 100%, the selling price. 40% of that they want it to be profit. So what is the percentage of cost? 100 minus this 40, 60. The percentage of cost here will be 60%. Percentage of cost will be 60%. And that 60% is $150. Here it is. The same aspect, $150. So here we did 150 into 140%, to $10, or the other way around, 150 into 40%, you can calculate, you'll get 60. You'll add it. They will apply it simply as a percentage on the cost and the markup. This is margin. We are talking about, my question was about margin. So here, cost is 150, but they say it's a case of margin and they want a profit of 40%, which means logically, since it's a case of margin, the base is, here the base was cost, here the base will be selling price, 100% will be selling price. So the cost percentage should be lower, it should be 40%, that is 100 minus 40. 60%, sorry, the cost should be 60%, 100 minus 40. So now the max. If $150 is a cost, and if $150 is 60%, if $150 is 60%, what is 100%? If $150 is 60%, what is 100%? This is what we want to compute. So what will you do? 150 multiplied by, if 150 is 60%, what is 100? So 150, either simply speaking, 150 divided by 60 into 100, that's what we are doing. 150 multiplied by 100% out of 60. This is what I'm doing. 250, like many of you said. Or so now 150 multiplied by, even if you don't put the percentage there, you'll get it. 150, that proportion is what matters. 150 multiplied by 100 out of 60. If this is 60%, what is 100? That's what I'm doing. This is a math that I'm doing. 150 multiplied by 100 upon 60. If 150 is 60%, what is 100%? That's why we are doing the math. 150 into 100 upon 60. 100 upon 60 will get $250. And that's the answer. The answer for the question that I asked here is $150. Sorry, $250, my bad. I'm saying $250. Now, Nisarga, I asked this question primarily because you raised the concern, you asked to repeat. I can see that you had given the correct answer. Some of others had given a wrong answer. But I hope now, to everybody, I hope you got a grip over it. Can I have a confirmation, please? Are we good? Are we neat with respect to markup and margin? Yeah, thanks. Are we all cool with markup and margin? Everybody? All good? Okay. Then let's go. I'll give you one more question again on markup and margin only. Both will be tested here. One second. Yeah, two questions. There are two questions in here. Try to calculate the answer for both. Try to calculate the answer for both. We'll discuss them. Calculate the answers for both parts, then we'll discuss. Both parts. Let's see. The ray selling price per product. Sales price per product. The cost is 70. So how can be 1.12 and 2.0? Okay. Think about what you're missing. Think about what you're missing there today. Cost itself is 70. How can you sell the selling price, set the selling price at 1.15 and sorry, 1.120? Thanks on the two answers. So when you pick an answer, think about the logic of it. Different answers until now. Popular answer I have got 112, 175. First one and second one, sir. Yeah, I agree. I very much agree, Dure, but 1.112 is not acceptable. Oh. Okay. Sorry. My bad. My bad. Thank you. First one and second one. Got it. Excuse me. My bad. Okay. Identical answers thus far from many students. I'll wait. Maybe 1 or 2 minutes. We'll wait. Okay. Different answers from Sneha. One common answer, but the value interesting. No more answers. I think the answers have tried up. Now that's surprising. Kind of surprising for me. No more answers. Most answers said 112 and 175 respectively. Let's cover this. Let's consider this. The first case is that of a markup. The first one is case of a markup clearly. They want a 60% markup. What is the cost? Cost is 70. Cost is 70. They want a 60% markup. So what will happen? We know in the case of markup, 100% is the cost. And they want 60% on this. They want 60% on this. So if you want, you can calculate 60% and separately put it. Or you can simply say the selling price should be 160%. of the cost. So 70 into 1.6 or 70 into 160%, 70 into 1.6 or 70 into 160%, 112. It will come to $112. Of course, you can do 70 into 60%, it will come to around 52. Oh, sorry, 42. We confirm 70 into 60%, 42. So 70 plus 42, it will come to 112. So the first answer, 112. 112. For the second case, they say, what if they want to sell it at 60% only, but margin? They have made it clear this time it's margin. So here, what will happen? What will be 100%? In this case, in the case of margin, as we know, this 100% will be the selling price. What do we know? We know the cost. The cost is the same 70. But they are saying they want a margin. Margin of how much? 60%. Profit margin of 60%. Which means logically, what must be the percentage of cost here? What must be the percentage of cost here to everybody? What must be the percentage of cost here? 40, 40, 40. Do everyone concur? The percentage of cost here should be, yes, it should be a smaller percentage and it should be 40% because 60% they want the profit. So 100 minus the 60, 40%. So if 40% is $70, what is 100%? 70 multiplied by, if 70 is 40%, what is 100? 70 multiplied by 100 divided by 40. 100 divided by 40. 175. The answer that most of you had given me is right. 112 and 175. Very good work. Sneha, your answer was slightly different if I'm not wrong. It was Sneha, if I'm not wrong. I forgot who gave that answer. I hope you have got an idea now, Sneha. I don't know where exactly your calculations went wrong. The values will be given the selling price. So the cost is $70. The values will be 112 for the first one and 175 for the second one. Are we good? Not just to Sneha, to everybody. Are we good? Are we clear? Anybody who had struggled, who may not have got the answer correct first time, are we good? Are we clear with this? Please do confirm. Are we comfortable? Are we clear? Yes, yes, yes. And again, it's okay to make a mistake, but what's important is whether you're able to follow the logic after the discussion. That's what matters end of the day. Okay, well and good. So that's the basic when you deal with cost plus pricing. Sometimes they'll use the term markup, sometimes they'll use the term margin. So we have to be aware. You can't rush and always apply the percentage easily on the cost because then your calculations may go for a toss. Your calculations may go wrong, as you have seen. So we have to be aware about it. It's actually a max concept, not even a CMA concept, but it's enough. It actually is enough for you to lose your marks because the meaning of markup and margin, as I have illustrated, tried to show you, are different. Now that that's over, now let's switch back to the core area. Like I said, market-based concepts, monopoly, oligopoly, etc. This we'll discuss tomorrow. Now I want to discuss a bit about the cost factors. Now, if you remember, when we discussed about the different costs, and the earlier two chapters in the sense, CP analysis and marginal analysis. And if you remember, we had a discussion about production costs. We consider the cost under variable fixed such behavior, mixed cost and all. We had considered that high low mother, etc. Then under marginal analysis, we spoke about the concept of relevant costing when we said only the future incremental cash flows will be considered. All those kind of things we had discussed, we had considered, we had contemplated, we had looked at. I hope you guys do remember. Now, costing is of different ways. In part one of your syllabus, you have a separate unit for it. You have a separate subject, D. The D subject in your part one syllabus, which you'll learn later, is costing methods. You will learn many costing methods there. Activity-based costing, absorption costing, marginal costing. You'll learn a bit about throughput. You will learn about target costing, process costing. You will learn about what is it? Service costing, job costing, many things you will learn there. But that's in part 1. Unfortunately, we have not done part 1. We have not done part 1, but we have done enough questions in relevant courses and all, wherein we have seen cases where they talk about manufacturing course, manufacturing as in production course, and certain non-manufacturing course like selling, distribution, administration, etc. We all know in a business, you may have one department, the manufacturing, the production, and you may have support departments like selling, distribution, administration, such other non-production departments as well, non-manufacturing. Production is also known as manufacturing department. So typically, say marginal costing, what do? We consider only the variable cost, not even the fixed cost. Relevant costing, though, it's very, very typical, very, very precise that way. It's separate. So typically what happens later, you will learn in part 1, is that most of these costing methods are not that inclusive. Most of the costing methods do not consider what happens across the life cycle for a particular product or a service. Once again, let me repeat this. Typically, most of the costing methods do not consider what happens to the cost, or do not consider all the costs of a product or a service. That is a problem. Why? To understand this, let me just quickly talk about the life cycle stages of a product or a service. What are the different life cycle stages that will happen to a product or a service? Let's have a quick discussion. Okay. A product or a service may go through mainly these 5 stages. A product or a service might go through mainly these 5 stages. The development stage. Remember, when we say the development stage, these are the 5 stages. What are they? Development, introduction, growth, maturity, decline. The stages of life cycle, it could be of a product or a new service, a laptop or a new type of, say, streaming service. It could be a mobile phone, it could be car, anything for that matter. What are the different life cycle stages for a product or a service? Of course, we know from the term, introduction is a phase where the product is getting launched in the market. The product is introduced, the market launch happens here. This is a phase where the product is launched for you and me to buy. The common customers will get a chance to buy the items at the introduction phase. That's where it starts it in the market. But even before the product is launched, companies will incur costs for it. When before a product is launched in the market, introduced in the market, companies nevertheless will end up incurring costs, suffering costs for it. And that is what happens in the development phase. It's pre-production cost in a way. It's a cost that the company will incur before even the production. So there are primarily 2 things will happen. Research, searching for new inventions, new technology, etc. Looking for different combinations, different design and all. Research and development, both will happen. Means large scale design and all will happen. And it can be very expensive. The stage can be very expensive that way. Many a times, especially in high investment companies, high technology companies, this cost can be high. The cost can be very high during this stage, especially if you have invested in a heavy technology and all for research. It is after the research and then once you have developed something that we actually will develop the product and launch it in the market. So actually, even before the product gets launched in the market, gets introduced for you and me, a company may have incurred huge costs for it. Then what will happen? They will produce it mass scale. They feel, okay, it's a viable product. They will launch it. They'll launch the product to us. Then provided, again, provided, not a rule, not a guarantee, but provided that your product gets a positive feedback. Assuming that your product gets a positive feedback in the market, the product will enter the growth phase. Assuming that your product will get a positive feedback in the market, what will happen? Your product will enter the growth phase. What will happen? Sharp increase in demand. Sharp increase in demand in sales. Sharp increase in demand means you'll be able to sell way more. It keeps spiraling, also going up. The demand level keeps going up. The sales goes up. Sharp increase during the growth phase. But will this growth in the sales, will it keep on happening forever? No, it will not keep on happening forever. Everything has a saturation, right? So usually what will happen? Maybe it may be there for a few days. Sometimes it will be there for months. Depends. By then, a new product or your competitor may come from with their alternative, their substitute to compete against us. Or Could be a case where we ourselves will come up with a better version. Right? That will also happen. It may not be a competitor. Our company ourselves may come up with a better version, updated version now. So what will happen? Slowly by that time, your products, that novelty, that newness in the market, the curiosity of the customers will wave off. The growth you'll not be able to enjoy anymore. The product will get mature. What will happen? Again, the sales is not drastically going to drop now, but the sales will steady. The sales will get steady, mature. Means what? The growth that we used to enjoy will stop. Rather, it will become more steady sales, stable sales. It's not going to grow anymore like it used to do during the growth phase. Then eventually what will happen? The product will wave out. The product will basically become either outdated or the product or the service will become outdated. It may happen in months, it may happen years. It will vary. The overall product life cycle, the stage, the overall life of a product will vary from case to case to case. But then it will definitely decline. At one point or other, it may decline. So what will happen? You understood that the product is not anymore that viable, either because competitor has come with a better product or the technology we are using for it may have got outdated, etc. The product will reach its decline phase. Which what will happen here? We'll withdraw the product from the market. We'll discontinue the product. We'll withdraw the product. We'll discontinue the product. And when this happens, when we discontinue the product, remember, this is very important for you to understand. Once you discontinue the product, there also, even after that, you may continue to incur certain costs for a product. Even after we have decided to discontinue the product, a company may incur certain huge costs for it. May happen. Not a rule, but may happen. It could happen. The reason I'll come to that. Okay, the reason I'll come to that. But before that, let me just go back to the earlier stages. Market launch. Now, marketing expense or advertisement expense may incur during different stages. But can you guess which is the phase, which is the stage where the marketing, the advertisement cost will be the highest out of these 5 stages? For a product or a service, during which of the stage do you think the marketing or the advertisement cost will be usually the highest? Any guess? Make a guess. Let it go wrong. But applying your commercial reasoning, when do you think the marketing cost will be the highest for a product or a service? Growth? Oh, let me see what others say. Maturity? No, not growth, not maturity, introduction. I'm not saying during growth or maturity, companies will not market their product. They will, they may. But they will incur the highest amount of, the highest percentage of marketing costs or advertisement costs for a product or a service. Usually, typically during the introduction phase. Give me a minute, okay? Just give me a minute. I'm sorry. Okay. Where were we? I'm sorry. So once again, remember, I'm not saying that marketing will not be done during growth or maturity. It may very well happen. But the highest marketing costs with respect to the marketing or the advertisement, the highest will be occurring during the launch phase. It will be the highest during this phase. Usually. Highest. Why? Think about it. That's the phase usually where the product is, a new product is getting introduced into the market. It's getting launched. That's the phase where that new product is getting launched in the market. So they want people to be aware. They want the customers to be aware that, okay, we are coming with a new product. Whether it is a product or a service, say a movie, for example. When will they market it the most? When it's getting released. When it's about to get released. That's when they'll introduce the market the most. A new laptop or a new mobile coming in. When will they market the most? During that intro phase. Those time. Then also they may continue, but the highest cost is usually incurred during that phase. Number one. Number two, discount. Usually what will happen, again, not a rule, but typically companies may, especially if you have good brand name, if the company have good brand name, you will launch the product at a higher selling price initially, like Apple, Samsung, etc. do. Initially, they may sell it at a higher price, at a very high price. Why? They have good reputation, so they know that irrespective of a premium price, high price, people will buy their product. Irrespective of high price, people will still buy because of the brand name reputation. So what is advantage? Per unit, the profit will be higher. During the launch phase, initial phase, per unit, the profit will be higher. But as we come along, as the demand level waves off, as the product gets mature, from this onwards, this phase onwards, usually during this phases, maturity and a lot during the decline phase, we'll start selling the items at discount. A lot of discount sales will happen during maturity phase and a lot more during decline. Decline is a phase where you are trying to clear the stock. You'll try to clear the stock. So whatever is stuck there, you'll try to sell it. Then, like I was saying earlier, when a product is withdrawn from the market, what happens typically under accounting books, the financial accounting books, when you prepare ledgers, balance sheet, income statement, etc., we are discontinuing it. So it's not anymore part of your cost of goods sold, because cost of goods sold, what is it? It's the production cost, sales minus cost of sales or cost of goods sold. That's how income statements are prepared. Right? Income statements are prepared when we say sales minus cost of goods sold, we'll get the GP, gross profit. So that cost of goods sold, for which we have a formula, which you'll learn again in part 1, opening inventory or opening stock plus purchase minus closing stock and all, but not required here, but you'll learn it in other parts. That cost, the cost of goods sold, is a production cost that we focus on. But then, even after the product is withdrawn from the market, even after we have discontinued a product or a service, a company may incur costs for it. A company might incur huge costs for it, which will happen after the withdrawal. Like, for example, dismantling costs. Say, for example, a flight or a machine or equipment, which is electronic equipment, which is high in radiation. So what will happen? Even after we have withdrawn that product, you may have to dismantle it. You'll incur huge costs. Or let's say a mining site. We can calculate the life cycle cost for a product or a service or even a project. So it's a mining site. So after the mining, everything is done, you may have to restore it. When I say restore, we cannot put back the minerals or the crude oil again back there. No, we cannot. But we will have to level it and all. The mining site that we have used and all, we have to level it back so that it can be used for other kind of work or other kind of work, like road creation or maybe housing, etc. So companies will incur huge costs for this restoration. So such huge costs could be incurred by a business post the decline. And then apart from all this, obviously is a production cost. When is production going to majorly occur? Production costs will majorly, production or the manufacturing costs will majorly occur. Majorly, by the way. It might continue during decline phase, but majorly it will be during which phases? Introduction, growth, and maturity phase. These are the 3 phases where production costs will be usually incurred. Out of that, growth will be the phase where you may incur that the most. But these are the 3 phases where the production costs will be incurred the most. Herein we have a problem. Why? In most of the other costing methods, what happens? In most of the other costing methods, we focus on only this production cost, manufacturing cost or production cost. In the other costing method that you're going to learn in part 1, like absorption costing, activity-based costing, job costing, service costing, etc., we'll focus on the production cost or the main cost, the operating cost. But then as you can see here, before this production phase and after this production phase as well, before the production phase, during the research and development phase, nowadays especially, those companies which have invested heavily in technology for the research work, they may incur huge costs. It's a pre-production cost. It's a cost that they are incurring even before they have started the production. Even before the product is launched in the market, introduced into the market, they will incur huge costs for this technological research, number 1. So it's before this. Similarly, after the production, everything is stopped. Post the discontinuation. Even after that, dismantling, restoration, disposal, such huge costs you may incur. Other costing methods do not consider this. Because most of the other costing methods focus primarily on which cost? Production cost or certain type of cost within that, like variable cost and marginal cost and And that's kind of a problem. Why? So to wrap it up, during the development phase, you'll incur research and development costs. During the introduction, you'll incur high marketing costs and all. During growth phase and all, you'll start incurring production costs. Here also, you'll end up having, by the way, production costs will be happening here also, by the way, like we discussed. But majorly, production costs will be incurring during the growth phase. You'll continue to incur production costs here, but start giving discounts. Here also, you'll have discounts. Huge discounts will actually happen. But you'll incur huge disposal, dismantling such costs as well. This is summary. But the point is, think about it. When can we say that a product is a product or a service? Whatever it is that we are calculating the life cycle. When can we say that that product or a service is truly profitable? You tell me. You think about it and you tell me. When can we say that a product or a service is truly profitable? When we just recover back the production cost, like material cost, labor cost, fixed overhead, variable overhead, etc. When we just recover back the production cost, like with what will be primarily incurred during introduction, growth, and maturity, or do we have to recover back all costs? When will you say that a product or a service or a project, whatever we are looking at, when will you say that truly that product has been, or that service has been, or that project has been financially profitable, financially investment worthy proposal? When will you say that? When you recover back, will you be happy? If you are the investor, if you are running a company, will you be happy? Will you be happy and satisfied if you are just recovering back just the production cost? Or if you are a business owner, if you are the manager, will you be more interested in recovering back all the costs? What will you prefer? Just the production cost or all the costs? Thanks, Sounda. Others? I hope you got my question. I'll repeat the question. As a business owner, as an investor, when will you be happy? Will you be happy if you recover back just the production cost? Or will you be happy, or will you say, okay, that product or that service has been profitable when you recover back all the costs? When will you be happy? When will you say it's profitable for you? All the costs, all the costs, all the costs. Thank you. I hope all of you guys do concur. I hope all of you do agree with the logic. All the costs. See, in our accounting, in our bookkeeping, in our record keeping, etc., or for budgeting purpose, pricing purpose, etc., you may categorize the cost into fixed, variable, mixed, etc. You may categorize as production and non-production, or manufacturing and non-manufacturing. All this categorization may happen, direct, indirect, everything may happen. But despite of that, all these are expenses. We'll have to, at one point or other, we have to pay for money for it. Right? We will not be paying money only for manufacturing, only for production. For non-manufacturing items also, like research, development, they are pre-production costs, pre-launch costs, or even post the discontinuation of a product, dismantling, restoration, disposal, such costs. They are all going to lead to expenses. Right? So when can we say that a product or a service is truly profitable? When we recover back all the costs, despite its classification, its behavior. And the other methods fail here. And that's where life cycle costing actually stands out. Because under life cycle costing, this method, what happens? This is a very inclusive method. Life cycle costing is the most inclusive costing method. Inclusive means what? It will include all type of cost possible. It will consider everything possible. So we are looking at cost-based pricing, but within that, what cost we are referring to in this method? We are not just referring to the production cost or manufacturing cost. We are referring to the life cycle cost of a product or a service. Full cost. What will happen under this method? We'll consider all costs directly or indirectly attributable to a product or a service or a project, irrespective of the department, irrespective of the time, irrespective of the year. If a cost, if an expense can be directly or indirectly linked to a product or a service or a project, consider that. So it's a very inclusive method that way. Life cycle costing, that way we can say it's a very inclusive method. What happens here? A very simple formula we have. We'll calculate the life cycle cost per unit here. How do you compute this life cycle cost per unit? All costs across a life cycle. So it doesn't matter when we say all costs across a life cycle, it doesn't matter which stage, whether it is development phase, whether it is introduction phase, whether it is growth phase, whether it is maturity, whether it is decline. It doesn't matter. It just doesn't matter. Which stage, it doesn't matter. Whether it is in year 1 of the product, year 2, year 3, year 4, doesn't matter. The year doesn't matter, the phase, the stage doesn't matter. All costs will take it as a numerator, divided by all units, the denominator. That way you'll get the total cost, the total life cycle cost per unit. And then what will you do? This cost will compare with the selling price. This cost will compare with the average selling price at which we believe we can sell the product. To confirm the financial viability, the commercial viability of the product. Means commercially, financially in the market, whether the product will be profitable. Is it really worthy? Does it really make sense to do the product? We'll decide this way. The average selling price that we'll be able to sell the product, we'll compare that with the life cycle cost per unit, the total cost per unit. Logically, a product will be viable, a product will be financially successful only if the average selling price is higher than the life cycle cost per unit. Only if we can sell that product at a level, at a price higher than the average selling price, only then it commercially makes sense to do it. Financially, it makes sense to do it. That's a simple agenda. That's a simple logic behind this model. Are we good? Are we clear thus far? I have given you the theoretical idea of what is life cycle costing. I know it takes a bit of time, but that's important because theory questions can come. That's why we spend time and learn the theory aspect of it. Now we are going to get into the numbers, the numerical part, the numbers, which we will see. But are we good? Are we clear thus far? Is the agenda, the logic behind this method, its relevance, its significance clear? What is its relevance? It's a very inclusive method. It doesn't disregard, it doesn't avoid any course. Any course which can directly or indirectly be attributable to a product, we'll consider that. And we'll say, let's compare the total cost per unit, the life cycle cost per unit. Let's compare that cost with the selling price we are going to sell. If we can sell at a price higher than that cost, then we say, okay, it's good. It's going to be successful product. If not, it doesn't make sense. That's the logic that we follow here. Let's see. Thank you. Thank you. I hope it's clear. So now it's high time that we go for a break. Right? Thanks for staying intact for this long. Good. Like I told you, we'll mix it up with the numbers and theory every day. I'll not continuously take theory only. That will basically tire you down because it's an online section, be more like a radio section. So, and I'm happy to see the responses and keep it coming. Keep it coming. We are not done. We'll go for a break now. 11:05 now. We'll go for a 11:08. Sorry. Yeah, 11:07. We'll go for a 11:07. Please be back by 11:25. Please be back by 11:25, which means around 18 minutes of break. 15 minutes actually. Please be back in 15 minutes, 15 minutes. Then we will start looking at the numbers part of it. We'll look at the numerical part of it. There is a bit more that you have to understand with respect to it. It's calculation and application, which you'll see post the break. Okay, post the break. And after this 2 questions are discussed, then I will check with you whether you want to continue or not. Only based on that, I will decide whether to go further or not. Okay, I will not torture you, taking it till 1 o'clock and all. That I will not do. It will all depend on how much you are able to hold intact, because I know online it's not that easy, that peaceful to maintain the attention. I'm very much aware. So we'll go for a break now. That's why I'm giving you long breaks as well. Okay, I'm giving you long breaks. Please be back by 11:25. 20 minutes break, almost 20 minutes you're getting. Walk around, have some fresh air, have some water, breathe, stretch yourself, and please be back by 11:25. 11:25. Okay. Yeah, it's almost time. I'll just take up the files that we have to practice. Give me a second, guys. Give me a second. Hmm. Okay. Now we are ready. We are good to go. I'll share the screen to all of you and we'll practice questions on life cycle question. We'll practice questions on life cycle question. Sharing the screen. Right. Hmm. Yeah. The question is here for your reference. The question is here for your reference. Attempt it for me, please. Attempt it for me, please. There are two questions. We already know the formula. We already have discussed the formula here. All cost, the numerator, divided by total units, the denominator. Okay. Read the question, understand the context. There is a numerical part and a theory part. Theory part, that is the comment on the tested price that we'll do together, that we'll discuss together. First, focus on the first part, the calculation part. Try to calculate the cost per unit looking at the whole life cycle. Means they want you to calculate the life cycle cost per unit. That's the question. That's the question. I'll wait. I'll peacefully wait here. Let's see what you guys bring. Let's see what you guys get. Calculate the life cycle cost payment. Calculate the life cycle cost per unit. Calculate the life cycle cost per unit is the question. I think I have got two answers. Okay. 1,247. Okay. 5 to 9.4. Okay. Two totally different values. I'll wait. I'll wait. Let's see what else I have got. 522.2. Okay. 522, 540, 1,247, 530. That's my high, I believe. Maybe so 529 point something. Those are got two very close answers. Okay, I'll wait. I will wait. Maybe 2 more minutes max. I'll wait. Okay, I've got more responses. Five to 9.4. A repeated answer. 530 again. Very close by answer. Okay. Let's discuss this. Let us discuss and close of this. Okay. How do we go about this? First of all, we need to understand that some of this course, if you have noticed this question carefully, you would see that some of this costs are given on a total basis, some are given on a per unit basis. Production cost per unit, customer service cost per unit. Whereas R&D, marketing, and disposal costs, as you can see, they are all given. These three items are given on a total basis. What do we need in our numerator here? Total cost. 29.4. Sound the question is asking you to calculate what the life cycle cost per unit. Okay, the life cycle cost per unit, not profit, not loss, not something else. They are asking you what is the life cycle cost per unit. 29.4. Okay, we'll see. So the life cycle cost per unit. What is the formula? The numerator is all costs across a life cycle. And like I said, R&D cost, marketing, and disposal cost given the last fifth item, these three are given on a total basis anyways. So I can directly sum it. I can directly total it. Right, one shot I will total it. 1,900,000 this. So 1,900,000 plus second year 100,000, 1 lakh, 100,000 plus what about marketing? 1 lakh, 75,000, 50,000, 10,000. As you can see, initially is more. When you're launching, that's when the most. 100,000 plus 75,000 plus 50,000 plus 10,000. I'm taking the total. These are all already given in total. I'm just cumulating, adding it up. Plus this 300,000. Disposal cost also given on a total basis. So 300,000. 3 lakh. Add up. So the items, three items are given on a total basis: R&D, research and development, marketing, and disposal. So this three will add it together. 2,535,000. It's coming to. Apart from that, there are two more costs. What are they? Production cost and customer service cost. Both are given on a per unit manner. If you're really sharp with the maths, we know that we can club it together and then multiply. Or if you want, you may separately have done the math. I don't know how you have done it. For your reference, I'll just do it together. Sorry, do it separately. First, the production cost. What is the specialty? Production cost and customer service cost both are given per unit, per product. So how do you get the total here? Per unit is here, number of units is here. I'll just have to multiply. But I need the total for all the 4 years. We don't care whether it is in year 1, year 2, year 3 here. The total. We don't do it separately for each year. So the total here will add up to, what will you do? The production cost. First year, what is the per unit cost? 500. How many units? 2000. So 500 into 2000 units. Plus, similarly, second year, I just cumulate it. I don't want to separately list it down and then prepare a table and waste my time, right? We have very less time in the exam, so very minimal working. 450 into 15,000 units. Second year, 450 is a per unit cost, production cost into 15,000. Plus, third year, 400 into 20,000 units. Plus, last year, 450 into 5,000. 450 into 5,000 units. Add up 18 million. We got 18 million in here. Now, the next part, customer service cost. The next part, the last part in a way, the customer service cost. Same logic. What we can do, we can multiply the number of units with the cost per unit. If you're really sharp, you know that year 2, year 3, year 4, 40 is the same cost. So you can actually club the number of units and do it if you want. Anyways, so what about customer service cost? First year, 50. 50 into how many units? 2000. Second year, what is the per unit cost for service? 40. So 40 into 15,000. Third year, how much? Again 40. 40 into what? How many units in third year? 20,000 units. Fourth year, again 40 per unit. 40 into 5,000. So 50 per unit into 2,000 for the first year, 40 per unit into 15,000 units the second year, 40 per unit into 20,000 the third year, 40 per unit into 5,000 the fourth year. Done. Add it all together, 1,700,000. Now what will you do? We'll add all of this together. We'll add all of this together. This is a total cost. 22,235,000. 22,235,000. 2 crore. 22 lakh, 35,000 if you want to put it in Indian terms. This is a total cost. Now what? Denominator is a total units. What's the total units in here that we are expecting? First year, 2,000. Second year, 15,000. Third year, 20,000. And the last year, 5,000. Club it all together, 42,000. So the LC, the life cycle cost per unit will be this 22,235,000 divided by 42,000. 22,235,000 divided by 42,000, 529.4. 2 or 3 of you had given me the exact value. I'm happy to see that the answer here will come to 529.4. Some of you had given me 530. See, if you have rounded and put it, remember, I will round it upwards to 530 only if it is 529.5 or above. If the answer here is 529.5 or above, I can round it to 530. Here it is 529.4. It's less than 529.5. So when it's less than 0.5, you can't round it upwards. Rather, you should be rounding it to 529 if you are rounding. I hope you got the point. So this is the math part, the calculation part. Any doubts, any questions on the calculation part? Are we good? Are we clear? All I have done, found out the total cost. So whichever cost was given per unit, I kept multiplying with the units of that year to get the total. And then divide with the number of units. That's all. Are we good? Are we clear? Yes, so yeah, Nisarga, I can see that you had given me the correct answer as well. So it's perfect. Others, are we good? Are we clear? Yes. Yes. Okay, well and good. So that takes us to the next part of this question. What's it? Comment on the suggested price. What is the suggested price as per the scenario? Suggested selling price 500. As we can see in the scenario, 500 is a suggested selling price. Now tell me, at 500, do you think this product will be viable? If they are planning to sell the item at 500, will it be viable? Will it be financially feasible? Will it be a profitable product? Considering the total cost we have figured out, if they sell the item at 500, will it be a profitable venture? Be a profitable product? Thanks, Nisarga. Others? Will be a profitable product? No. Right? It won't be a profitable product. That basically will be the case. It won't be a profitable product. The product will be not be financially viable, financially profitable at 500. It won't be a viable product. That's basically our reaction, our deduction, our observation. The comment will be that if they have to sell at 500, if they can't increase the selling price at 500, it won't be a profit making product. It's not worth it. That's it. So one more round, one more question. Okay, one more question on life cycle costing. Here we go. There are two questions in here. Read the question carefully, then answer. What is the expected total life cycle cost per installation? Number one. Number two, how much should the company charge per installation? Read the question carefully, understand the details given, look at the profit they are looking for, do the math. Two figures they are looking for. Right? They are looking for two figures here. What are they? The life cycle cost per installation and the selling price per installation, because it's per installation. It's per installation. So they want to know two things: the life cycle cost per installation, number one; number two, the selling price per installation. Two things. Work it out to the best of your ability. Let's see. I'll wait. Let's see. Okay, one answers on the past. Thanks on the. I'll wait. That's what they say. One more set of answers I have got. Let's see. Anita, thanks. More or less the same answer from both of you. Wait. And Sneha, only one part. You have given me the answer. Okay. I have got a few more responses. Let's see. Santosh, 1450. Per charge 1.4. Okay. Two thousand 42 three post charging in 2016, three post charge. Guys, okay. Guys, read questions carefully. Okay, read questions very, very carefully. Okay. Now, I don't understand how some of you said three per product and all. Okay, anyways, how do we do it? The total cost. What are the total costs in here? The total cost will add up to how much? Total cost will be 750,000 plus 500,000, 5 lakh, 500,000. They have given the cost in total, so it's convenient. 3 lakh, 300,000 plus 2 lakh, 200,000 plus that is marketing, distribution 100,000, customer service 250,000 plus 60,000 after sale support. We'll incur some support, some after sale support we'll give. So all that included, it will come to 2,160,000. What is the total number of installations? 1,500. Make no mistake, don't do 1,500 into 6. Of course, it has a 6-year life, but they are not here saying that, okay, every year they will sell 1,500. They're not saying 1,500 per year. They just said 1,000, the total, the company plans to sell, or rather set how many installations, 1,500 installations. So total is that. Otherwise, the question has to sell 1,500 per year. They have not mentioned that. So the overall it is 1,500 only. So what is the total life cycle cost? 2,160,000 divided by 1,500, 1,440. This is a life cycle cost. This is LC. LC is what? Life cycle cost per installation. Cost per installation will be 1,440. The life cycle cost per installation will be 1,440. What is the selling price per installation? They want a markup. They want a markup of 40%. Markup of 40%. So 1,440 into markup case. So cost is 100% into, I can directly do 1.4 times because this is 100%. This is 100%. Selling price will be basically this plus 40%. 140%. So that's peaceful. Now, some of you had given me answers of 3 and all. I think, I'm not sure. 1,500 divided by 500 or 1,500. What did you guys do? I'm not understanding. I'm not 100%, 1.3, etc. Why are you doing that? This is already per installation. It is already per product. Right? Each product will go and install it. Like, say, for example, washing machine, they may come and fix it for you. Or if it's big television, they'll come and install it for you. So I'm not understanding the logic that you use there, wherein you again divided it. We already divided the total cost. You divided with the number of units to find out the cost per unit. Why are you second time dividing? Many of you had given me the answers of 1.3 and all such range. Think when you're answering. Don't just randomly do it. Here, the total number of units was 42,000, so we divided once. Here, don't double divide it. Already to calculate, we divided it. You got the cost per installation or per product, 1,440. Add 40%, you'll get the answer. So the two answers are ready. 1,440 life cycle cost per installation, and the selling price, the price they should charge to the customer is what? They want 40% markup. Markup means cost will be 100%. So since the life cycle cost is 1,440, selling price should be 2,016. Thus far, are we good? Are we clear? Can I have a confirmation, please? There is more to it. Yes, that 500 I will talk about it. But thus far, are we good? Are we clear? Is a calculation done thus far clear? Yes. Now, the next part, some of you at least might wonder why I have not considered, why I have not bothered to consider this 500. Why I am not bothered to consider this 500 too. Now, let's consider, for example, you're buying a bike. You're buying a two-wheeler, a bike or a cycle, whatever. We are the company here, right? When you calculate the life cycle cost per installation and then fix the selling price, you're thinking like a company. So for the company, they will incur R&D cost, material cost, manufacturing cost, distribution cost, certain customer service, and after sales costs. The cost that the company will incur, the cost that our business, in this case, business software will incur, that is part of our cost, which means 1,440. And on this, we'll charge a profit of 40%. So added that 40% will come to selling price will come to 2,060. This 500, this is not something that the company incurs, business software incurs. So like a bike, you buy a bike, right? You buy a bike. After buying the bike, on an ongoing basis, you have to fill the fuel. You have to fill the fuel. And after the warranty period, after sales support will be there only for a certain period. After that, you may have to maintain. You may have to incur certain costs for changing the tire. You may have to incur certain costs for basic service, etc. Will the company pay for it? Such costs, fuel costs, other running costs, insurance costs, all this, will the company pay for that? In this case, the business software, do they have to pay for that? This 500 wala cost for the ground installation, training, operating, certain services, of course, installation will be done by the business. But here, looking at the details given here, training, installation, training the workers on how to use it, operating, maintenance, etc., and disposal costs. Obviously, who will do it? Like I said, in a bike case, once you purchase the bike, the cost for running the fuel, the insurance cost yearly to be paid, after the warranty period, the repair cost and the lien income. Will the company pay for it? Will the company pay for it? What do you think? Will the company pay for it? No. The brands, TVS or Ather or Ola, whatever it is, they will not pay for it. Who will pay? Customer will have to pay for it. Right? The customer will have to pay for it. So these are the company costs. These are incurred by the company, the business. In this case, business soft. This is additional cost that the customer will have to incur. But this is a running cost that the customer have to incur. Of course, in certain examples, they'll tell installation or the company will provide. Of course, that automatically that will be the cost for that. They'll consider that when they set the price. It will be there. In this question, that's not how it is given. So that's why that 500 we are not taking, because that 500 is a cost that the client will incur, that the customer will incur, not us. Our job ends with this. So 1,440 and add the 40%, you'll get the selling price. Per installation, we need to charge to the customer for each installation 2,016. The charging rate. Second answer. Thus far, are we good? Are we clear to everybody? Thus far, are we good? Are we clear to everybody? Thank you. Thank you. Thank you. Thank you. Okay. Now, let me put an additional question. Read the question carefully and then answer. Okay. I'm giving an additional question now. Answer to this question. What if they asked you an additional question here? The additional question is, what is the customer lifecycle cost per unit or per product? There was an additional question asking, okay, same scenario, but they had asked you, what is the customer lifecycle cost per unit or per product? What is it? Yeah, per product or per unit. What would have been your answer here? What would have been your answer here? Let's see. Santosh, think an answer here. Think. Apply your logic. Navneeta, 0.33. How are you getting it? Dear, we just now saw that the per installation, per product cost is 1,440, dear. Again, coming to 0.333 and all. Navneeta, when you calculated 1,440 2016, did you understand the calculation till there? Did you understand the calculation till there? Yes. Okay, thank you. So why are you then there? We already have divided here. There we already have divided with the number of units, the installation. So why are you again dividing? Or if you're talking about this 500, if we are basically done 500, if it's a case where you divide this 500 with 1,500, if that's what you have done, see, that is also per installation. Read carefully. Don't lose marks over silly things. If it's a very complicated topic and you lose marks, I can understand. But when you're careless and you lose marks, nobody can help you. They're not saying that 500 in total. They say the company envisions that an average client, one client will incur 500 for operating, training, maintenance, disposal, etc. for the product per installation. So this 500, Nanida, this 500, is it per product or is it in total? Is it per product or is it in total, dear? It's in total. It's not in total. You have taken it in total. You thought this 500 is for the entire 1,500 units. They say 500 per installation. Read the sentence fully. When you start a sentence, read it fully, understand its meaning, then do. They say one client will incur 500 per installation. 500 for each installation. In total, the customers will end up incurring 500 into 1,500 installations, a huge amount, 750,000. We don't care about it. That is for 1,500 different customers. 500 is per installation per product. The total of training plus operating plus maintenance plus disposal cost, the total is adding to 500 per product. Is this clear to everybody? Is this clear to everybody? So the others, 500 is per installation. It's not very difficult. And a bit of tiredness when it's an online class, that'll be there, but otherwise it's actually carelessness. If you take it as per unit, if you take it as per overall total, it's carelessness. Read that sentence fully, you'll get it. Average client, per client, and client, which means one client, 500. And towards the end of that sentence also, this is per installation. And per installation, what is our selling price? 2016. Now coming back to the answer, many students gave me the answer 1,940. What happened to the 40 today? That 40 you gave a discount. Right? It's not 1,040, 400, not 1,440. So many students gave me the answer for the life cycle course for the customer. Many students gave me the answer. Don't give a discount like 40 and all just like that, okay? No need to say sorry, but your answer will be wrong, okay? So many students gave me the answer of 1,440, the life cycle course plus 500, 1,940. This answer I got from many students. Sounder says 2,516. Before that, he only had given 1,940. Okay, interesting. Is there anybody else who said 2,516 now? Noted. Here, 1,900, 1,940. Let me see. Manita had given earlier 0.33. I already spoke to her. I spoke to her. Then Sneha, 4,320. I don't know what you had done there to get that huge a value, Sneha. 2,516. Now, but in a way, Nisarga 1,000 now, 940. Durai 1,000, okay, 940 range. Santosh 500. Now, Santosh, the question is what is the life cycle cost for the customer? Understand the life cycle cost for the customer. Okay. Let's see. Sound the okay, done. I think almost we are done. Okay, let's go. So now 1,940. Okay. See this 1,940. If you have got an answer of 1,040, that is also wrong, dears. It's wrong. Apply your logic. What is the price at which the customer will be able to buy the item from us? See, one is a buyer, one is a seller. Understand why? One is a buyer, one is a seller. Until now, the first two questions we solved from the seller's perspective, from the business perspective, from business soft perspective. The third question, the additional question is asking you to think from the customer perspective. At what price or at what cost are they purchasing this item? At the time of purchase, or what is the amount they have to pay to the business of the company? Let me repeat the question. When they buy this product, how much do they have to pay to business soft? 1,440 or 2,016? How much do the customer have to pay to the business soft? How much do customer have to pay to business soft? Thanks, Sonda. Yes, your logic there is perfect. Yeah, very good. 2016. 2016. Good. What is the price for the customer? See, our cost is 1,440. Who? Business cost. But our selling price is 2,016. Our selling price, the business 16, including 40% profit that we want. So that will become the cost for the buyer. No. This is business selling price. 2016 is business of selling price. And this selling price will become what? The purchase price for the customer. For the client, for the customer, this will be their purchase price. So what is their cost? Company's selling price is the purchase of the buyers, the customer, the client's buying cost. Once again, the company's selling cost, selling price rather, the company's selling price will become the, 1 second. Okay, so coming back. So my family is telling me like not to talk this high pitch, throat will go. Okay, so coming back to the point. So simple logic. This is the first two questions we solved from business of the business perspective. The third question is from the customer's angle, customer's perspective. So the company's cost is 1,440. Their selling price is 2,016, which will become our purchase price. Our as in the customer's purchase price. The customers, when they purchase, they have to pay 2,016. Plus what? They'll end up paying how much? 500 for installation. Sorry, 500 as running cost. 500 is additional cost for the running. Running in the sense, maintenance, disposal, operating, etc. 500. 2,516 will be the life cycle cost spent. I'll just provide the breakup here for your reference later. Purchase price per product per installation for the customer will be 2,016. Company's selling price will become the customer's purchase price plus the running cost per product. Running cost is the cost they'll incur during the life cycle for maintaining, operating, etc., which is 500. So that way, what is the cost? The last question asked you, what is the customer's life cycle cost per unit? So they'll have to pay. When they purchase, they have to pay upfront. At that time only, time of purchase, they have to pay 2,016. And for the running fuel or whatever different operating expenses, 500. Total cost for the customer will be 2,516. It will add up to 2,516. Angle. One word meaning can change the question, change the meaning and change the answers. So this is where I want you to be very, very careful. Very much like if you remember in CVP discussions and marginal analysis also, I mentioned this. Read the questions very carefully. They can give a scenario like this. They may ask you, what's the life cycle cost payment for business soft? Then the answer should be 1,440. They may also ask you, what is the selling price per installation? There, 2016. But if they ask you, what is the customer's life cycle cost? The answer shouldn't be 1,440. It shouldn't be 2016. It should be 1,440 plus 500 either. Because 440 is the cost of the business. We want to understand the cost of the customer here in the final question. So we'll consider, okay, what is the price we have to pay, the cost the company, the customer have to pay at the time of purchase. Selling price of the seller, the business will become client's, the customer's purchase price, the buy price. That plus the running cost of 500, 2,500 system. That cut up. It's logic. It's actually, when you think about it, is it to whom? Duray? Was that for me or was that for somebody else? Okay. So whomsoever that you meant for, I hope they also take in that spirit. Done. 2,516 will be the answer. I think I don't want to. I wanted to start with target question, but I think if I go further, it'll be a sourcing for you. Thanks a lot for joining me and being here for this long for online section. Tomorrow, the same exercise. Again, we'll mix a bit of theory with a lot of numbers. We'll mix and match, and that we'll discuss along with the question practice that may happen also, depending on the flow. We are done for the day. Same link, the same meeting link you can use for. That is for Sounder. Okay. No problem. Absolutely fine. Okay. Happens, I know, especially in online classes. So I hope the logic, once again, remember, it's okay to get it wrong when you do a class question. It's okay to misunderstand, miscomprehend. But once we have discussed the solution, I hope the logic of it, the reasoning, the logic behind it, you are able to connect. So once again, read the questions carefully. Understand the perspective, then answer. Let it go wrong initially. When you practice also, here and there, you may get it wrong, but that's fine. It's part of your learning. So when you make a mistake, when you misunderstand a question, it's part of your learning. Take it that way, right? Take it in a positive way. So that mistake basically adds on to your knowledge bank. What should happen is, as we go along and practice more questions, such mistakes should come down. So that eventually when you do the mock exam, mistakes is even lesser. And when you do the final exam, it will be that much more lesser. That's a long run idea. When you practice initially for a concept, you are likely to get it wrong, and that's fine. That's part of learning. I'm very happy with what we have done today. We finished marginal analysis, the question practice that we had to do in the LMS that we have finished. Then we moved on. We talked about the factors that can affect the price. I hope you remember. We spoke about the difference between markup and margin, practiced a question on that, which is a small concept. Then we moved on. We discussed about life cycle cost. Now tomorrow, target costing. Then we'll talk about market factors that can affect the price, the different type of market. We'll talk about price elasticity of demand. And then price elasticity of demand, PED, the calculation part. And then after we reach until there, those three topics, depending on the time that we have, we may discuss how market demand and supply may affect the price. That part also we'll discuss. Again, that depends on the time part. That's it for the day. Thanks a lot, guys. See people tomorrow. Thank you. Thanks for your time. Thank you. We need to attend online classes, sir. This 1 week we need to attend online classes. See, Santosh, I was okay in coming down, but then what I have been told is the college is closed, so we'll not be able to conduct it fully. So what I have planned is we'll have class till Friday. So we'll not have class till Saturday. That is till Friday. So today is Tuesday. We have 3 more classes like this, around 4 hours of class, 4 or 3.5 hours of class. And after that, there'll be one final class that I may do, depending on your requests. When you are about to do your paper, when you as a batch, when you are ready to appear for the paper, at that time, if you want a quick recap, more of a revision of what I have covered for you, the Part C chapter, Part C subject, at that time, we'll conduct a class. By then, I think your college will be open. This, I want to finish the syllabus, the first coverage part, which we'll do by Friday. For sure, we'll be completing by Friday. So that you can practice and do. That part is not delayed without continuity issues. But then, we can have one final interactive section where that will happen depending on when you ask for it, depending on if during the final lab, if you want a revision class for different subjects, they might want you to give a extra revision class. At that time, I may come down one more time to the campus. And regarding the other papers, I have committed only for this paper. So the rest of it we'll see as we go along. Okay. So the next 3 classes for sure. That is Wednesday, Thursday, Friday. These 3 classes will be online. Post that again, it'll mostly once your college resumes and by then your internship starts, junior internship starts, so we will not be able to conduct a class. Post that, mostly some faculties will be coming down for other papers. Mostly they'll be coming down to take classes. That's what I understand from Balasa from Vidyarupa. That's what I have understood. We are taking these few classes online only because we are not able to come down and do it. That's what I have been told. Otherwise, I was available to come down for this 3 days. Okay. So I hope that is clear. So it's not forever. It is only for this 3 days. It is only for this 3 days. That's it. That's it, guys. Have a wonderful day ahead. Enjoy the day. See you people tomorrow. Once again, thanks a lot for the patience. See you tomorrow. Bye. Bye. Bye-bye.